Of all the elements on Earth, why did one shiny yellow metal become the backbone of global finance? Why do central banks hoard it, investors chase it, and markets still move because of it? This is the story of gold, the metal that built empires, backed economies, and might just be challenged by digital code. In 1717, Isaac Newton's reforms helped tie money to a fixed amount of gold. This led to the gold standard, where currencies from different countries had universal value and could be exchanged for gold. It brought trust and stability to global trade. After World War I, nations tried to return to gold, but failed. War spending, inflation, and mismatched exchange rates led to deflation and the Great Depression. After World War II, 44 countries met at Bretton Woods to build a better system. They made the US dollar the only currency tied directly to gold, and all other pegged to the US dollar. This created a fixed exchange rates and rebuilt trust in the global economy. But the US printed more dollars than it had gold, funding war, space programs, and domestic spending. Other countries started demanding their gold back. In 1971, President Nixon ended gold convertibility, effectively ending the system. From that point forward, money was not backed by gold, going into what we now call fiat currency. Well, the logic is simple. We still trust gold. Even in 2025, central banks like those of US, China, and Germany hold thousands of tons of it. Why? Because if everything else collapses, gold still influences inflation expectations, national reserves, and even global debt settlements. Let's look at some examples. First thing you will probably notice when you look at this graph is the significant increase in gold price from 2011 to 2013. There are several major events that pushed gold prices upward during this period. First is the long-term decline of the US dollar. The US had been running a trade deficit for decades. This weakens demand for the dollar globally, causing its value to fall. Investors moved to gold as a more stable alternative. The second reason is the 2008 financial crisis fallout. Although the housing bubble burst in 2007, the full financial crisis hit in 2008. In the years that followed, gold soared as people looked for a safe haven. The third reason is the Greek debt crisis. Greece's economy collapsed under the weight of debt. Fear spread across Europe about the stability of the Eurozone. Again, investors turned to gold for security. The fourth reason is the rise of gold ETFs from 2004. The launch of the first gold ETF in 2004 made it easier for regular investors to buy and sell gold. In short, between 2007 and 2013, people were losing faith in banks, in governments, and in currencies. Gold became the ultimate backup plan. When we look at gold price graph again, there's a clear period of stagnation between 2013 and 2018. This wasn't random. It was caused by a few forces that made gold less attractive. The first reason is a strong US dollar. A rising dollar means it takes fewer dollars to buy the same amount of gold, which puts downward pressure on gold prices. The second reason is a rising US real interest rates. When real interest rates, or interest rates adjusted for inflation, go up, safe assets like bonds becomes more appealing. Gold, which doesn't yield interest, becomes less competitive by comparison. The third reason is the decline in global commodity prices. The prices of major commodities like oil and copper were falling. This typically signals low inflation and weak global demand, both of which reduces the urgency to hedge with gold. Let's take one last look at the gold price graph. Why have gold prices surged over the last 2 years? Gold's recent surge isn't random. It's the result of multiple global shocks, what economists call black swan events, combined with growing fears about inflation, war, and trust in financial systems. With the first two reasons being the Russian-Ukrainian war in February 2022 and the Israel-Hamas conflict in October 2023. The third reason is the global inflation surge from 2022 to 2023. After the COVID pandemic, supply chain disruptions, energy crisis, and massive government stimulus led over 8% of inflation in the US at its peak. Gold became a key tool to hedge against inflation. The fourth reason is the record central bank gold purchases. In 2022 alone, central banks from countries like China, Russia, and India bought over 1,100 metric tons of gold. The fifth reason is the US banking shock. The sudden collapse of Silicon Valley Bank triggered fears about systematic banking risk in the US. As trust in traditional banks weakened, gold once again became a safe haven. The short answer to that question is, it depends. Gold has historically been a safe haven asset. That means people buy it not to get rich, but to avoid losing wealth during uncertainty. Individual investors should be aware that gold has a long investment cycle, typically lasting 4 to 10 years, and can experience high volatility, with prices swings of over 50% up or down. These characteristics make gold unsuitable for most investors. It is better suited as a long-term allocation for professional investors who understand how to manage such risks. For beginner investors, buying ETFs is always a better option most of the time. Let's compare their prices over a period of 20 years. As you can see in the graph, Nasdaq, with a growth of 1,282.85%, is much greater than gold's growth of 695.43% over 20 years. An interesting question will be that recently, another type of commodity has crept up on gold, Bitcoin. It has all the properties that gold has. However, Bitcoin is more secure than gold because it is almost impossible to decode the system of blockchain and it is easy to transport. For that reason, is it possible for Bitcoin to replace gold someday?